Assalamualaikum, my name is Nurmazmin Hanim. Today we highlight 7-Eleven Malaysia. Since 1984, they have grown into the nation-leading 24 hours retailer with over 2,600 stores. Serving 1 million customers daily, they provide essential network across both urban and rural Malaysia. Their vision is to be the best retailer of convenience. This is driven by 4 values: understanding, simplifying, solving, and connecting. These principles have allowed them to adapt to changes consumer lifestyle for over 40 years. The current strategy focuses on the 7 cafe format. By emphasizing fresh foods and premium coffee, they are shifting from a quick stop shop to a lifestyle destination. This transition is the primary engine for the increasing footfall and driving future profitability. From their first store in 1984 to their 2008 14 in IPO, their growth has been consistent. Celebrating their 40th anniversary last year, 7-Eleven remains the convenience king by staying always there for you. Perspective analysis. 7-Eleven Malaysia is entering a high growth phase with sales projected to rise from RM 2.92 billion to a growth rate of 9.3% in 2025. This is supported by stable 1.32% net profit margins and a strong 78% dividend payout ratio. Our pro forma analysis identified an additional fund returns of RM 118,000 in 2025, rising to RM 28 million by 2026. It is critical to note that this is technical accounting gap caused by RM 1.34 billion capital reorganizations deficit, not an operational failure. While our share capital remains steady at RM 1.41 billion, this additional fund needed reflect the capital required to expand our 7 cafe format while maintaining high dividends. By leveraging internal cash and strong supply credits, we are well positioned to sustain our market leadership through 2026.
Hi, my name is Zurina Dira. So overall, the company total asset show a decline from 2022 to 2024, dropping from about 2.68 billion to 2.46 billion ringgit Malaysia, and current asset decreased mainly due to lower cash and bank balance in 2024, although inventories and receivables improved slightly, and also right of use asset remains strong, rising to 744 million, showing continued long-term commitment. And however, total non-current asset in 2023 dipped significantly before recovering in 2024. And in summary, the company maintained strong fixed asset but faced pressure on liquidity due to lower cash level and leading to a slight reduction in total asset over the 3 years. Next is total liability decreased from 2.45 billion in 2022 to 2.11 billion in 2024, showing an overall improvement in the company leverage position. Current liability reduced mainly due to lower borrowing and lower trade payables, although these liabilities increased slightly in 2024. And equity improved strongly in 2023 but dropped slightly in 2024. And the improvement was mainly supported by growing retained profit, which rose from 103 million to 299 million by 2024. Overall, the company is becoming less dependent on debt while strengthening its equity base, indicating better financial stability over the 3 years period.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Ashiki binti Muhammad Aziz. So for this section, I'm going to present the financial ratio analysis of 7-Eleven Malaysia Holding Berhad Group for 2022 to 2024 based on the ratio in the report shown on the slides. So first of all is liquidity analysis, which evaluates the company ability to meet short-term obligations. So the current ratio improved from 2022 to 2023 but declines in 2024. So this indicating tighter liquidity in the current year. However, if we take a look at the days to sell inventory, it decreased consistently over the year. So it shows that 2024, the inventory is faster turnover. It helps support liquidity despite a lower current ratio. So now we take a look at the capital structure and solvency. So basically, capital structure analysis is focused on financial risk and leverage. So the debt ratio, if you can see here, it remains high throughout the period, showing that the assets are largely financed through liabilities. So similarly, with the total debt to equity ratio, is very high, indicating strong reliance on debt financing. So this confirms that the company operates with high leverage capital structure, increasing the financial risk. Next, we take a look at the profitability. So basically, profitability analysis, it measures the company ability to generate profit. So from here, we can see that the return on equity peaks in 2023, 0.89, but falls significantly 2024, indicating weaker return to shareholder in the current year. So at the same time, we take a look at the net profit margin, declined sharply in 2024, reflecting reduced profitability due to cost pressure. So next, we go to the asset utilization and efficiency. So basically, utilization ratio, it evaluate how efficiently asset are used. So basically, total asset turnover improve overall and remain high in 2024 compared to earlier years, indicating efficient use of asset to generate sales. Meanwhile, the inventory turnover, if you can take a look here, it also increased 2024. It's showing that faster movement of inventory and improvement in operational efficiency. So in conclusion, the analysis shows that liquidity and profitability weakened in 2024, while the company continues to rely heavily on debt financing. But however, improvement in asset utilization, particularly inventory turnover, helps support operation efficiently. Thank you.
My name is Nurul Aiza and I will present about stock market performance. The first one is total dividend distribution, showing it increased sharply in 2023 due to higher profitability and strong cash flow, while the reduction in 2024 reflect a caution payout strategy adopted in response to market uncertainty and the need to retain earning for future stability. Okay, next is earning per share or EPS. It increased significantly from 2022 to 2023, driven by strong revenue growth and improved cost efficiency. However, EPS declined to 3.75 in 2024 due to lower profitability, higher operating expenses, and challenging market conditions. Next, the price earning ratio (PER) declined slightly in 2022 to 2023, indicating improved earning relative to share price. However, it increased to 1.13 in 2024 due to lower earning and a relatively stable share price amid cautious investors' sentiment. Next is dividend per share or DPS, increased from 2022 to 2023, reflecting higher profitability and strong cash flow. However, it declined to 0.019 in 2024 as the company adopted a more conservative dividend policy in response to reduced earning and market uncertainty. Lastly is book value per share or BVPS. It increased steadily from 2022 to 2023 and further to 2024, reflecting the company accumulate of retained earnings, strengthen equity base and focus on a long-term financial stability despite fluctuation in profitability.
Assalamualaikum. My name is Nur Fahmi Amira binti Osman and I will continue the presentation to analyze the cash flow performance of 7-Eleven Malaysia Holding Berhad for the financial year 2022 to 2024, focusing on operating, investing and financing activities as well as the company's cash flow and sustainability. Net cash generated from operating activities declined significantly over the 3 years period. Operating cash flow decreased from 465.96 million in 2022 to 257.01 million in 2023 and further to 111.88 in 2024. Although the company remained cash generative, the consistent decline indicate weaker cash generation from daily operation, mainly due to the lower cash receipt from customer and continued high payment to suppliers and employees. The group should focus on improving operating efficiency by better managing costs related to supplier and labor. Improving inventory turnover and sales efficiency can also help strengthen cash inflow from operation. Cash flows from investing activities were highly volatile. In 2022, the group recorded a net cash outflow of 179.8 million due to capital expenditure. In 2023, a net cash inflow of 423.46 million was recorded, mainly from a one-off disposal of a subsidiary. However, in 2024, investing cash flow returned to a net cash outflow of 351 million, reflecting continued investment spending. This shows that the strong cash inflow in 2023 was not recurring and was driven by asset disposal rather than normal business activities. The group should adopt a more disciplined approach to investment spending by prioritizing projects that generate long-term cash return and avoiding relying on asset disposal as a regular source of cash. Financing activities recorded net cash outflows throughout the period, increasing from 147.51 million in 2022 to 342.41 million in 2024. These outflows were mainly due to repayments of borrowing, lease liabilities, and dividend payment. The increasing in financing outflows, together with declining operating cash flow, may place pressure on the company's cash position. The group should review its dividend policy and debt repayment commitment to ensure they are aligned with its operating cash flow capacity. In terms of cash position, cash and cash equivalent increased significantly to 799.47 million in 2023 but declined sharply to 217.95 million in 2024 due to heavy cash utilization for investing and financing activities. The group should maintain a minimum cash buffer and improve cash flow planning to support future obligations. And rising financing outflows raise concern about long-term cash sustainability. Strengthening operating performance, managing investment carefully, and aligning financing decisions with cash-generating ability are important to ensure sustainable financial performance.
In conclusion, we believe that it is worth it to invest with 7-Eleven Malaysia Berhad. Data here shows that amount has fluctuated but the difference was not in a large amount. However, based on the debt ratio, we can see the company has success to maintain low financial risk from 2023 to 2024. This number explains that the company has recovered after the pandemic and getting more profitable every year. This indicator shows that the company will give a good return to their shareholders.